I'm Tyler Suiters in the Energy News Center. You, of course, remember which president said it's the economy, stupid. Well, it turns out when you're gauging the future of oil prices, the economic ties are undeniable right now as well. Joining us now is Elliott Gue with the Energy Letter and the Energy Strategist, our regular analyst on oil and natural gas issues. Elliott, good to have you back with us.
Good to be here.
We're tying this to the economy because a new jobs report is out on this Thursday morning, and there is a clear connection between what the report says and how the oil market's performing right now.
Absolutely, and in fact, you saw the futures in the morning really spike when the jobs number came out because it was a little bit better than had been expected. It was still an overall monthly loss in jobs, but a little better than expected. And more importantly, there had been some whisper numbers out there that as a result of the big snowstorms that we've been having all through the month of February, it would be a really bad number, like something like 100 or even 200,000 jobs lost was sort of being floated out there. So there was a lot of nervousness ahead of the release. When it came out and showed a relatively small loss and smaller than expected loss, the market spiked, oil spiked, pretty much all commodities spiked. Because the idea is that there is an economic recovery ongoing and that that will support demand for oil and other energy commodities.
Is it a relief to you that perhaps oil prices are less tied to the strength of the U.S. dollar and more to the U.S. economy?
Yeah, I mean, I think the fundamentals, long term, I mean, currencies can definitely have an effect on oil, natural gas, any commodity in the short term because those commodities are all priced in dollars. And therefore, when the value of the dollar goes down, the value of the commodities goes up in dollar terms. But it is more encouraging when you actually see actual fundamentals supporting commodities because that's what's going to drive this thing longer term. You want to see more than oil being just simply a currency trade. And I think we're kind of seeing that. We're seeing some signs of a return of demand in the U.S., or at least a moderation, sort of flat year-over-year demand. I think we will see over the course of the year some demand come back. One sector to look at carefully there is the refiners. We've seen the refiners actually spike very, very sharply over the last couple of days. That group has been just decimated over the last year. They're very sensitive to that oil demand in the U.S. So I do think we're seeing a little bit of that. More importantly, we're seeing very, very strong growth in places like China and India. There's a report out in February saying that last year, for the first time since I think 1982, U.S. oil imports from Saudi Arabia dropped below 1 million barrels a day. The same year, Chinese imports from Saudi Arabia jumped over 1 million barrels a day. So there's a big shift underway in the global oil market as well.
Yeah, we're no longer the Saudis' #1 customer, at least for now. We'll see how things shift going forward. What does that tell you, Elliott, about the longer-term outlook for oil right now and the factors that are at play, the more traditional factors that we're used to seeing affect crude prices?
Well, I think it's going to get back to that a little bit. The demand thing has been driving the oil market really since mid-2008. The idea has been that if the economy is weak, oil demand is slumping, and therefore the spare capacity in OPEC has really ballooned, meaning there's a lot of additional capacity can be brought online very quickly to meet demand. The question is, as demand begins to come back, I think the focus is going to reshift to supply. And what I mean by supply is, what does non-OPEC supply look like? Are we going to see continued declines in countries like the North Sea countries, like Mexico, in terms of production? How much actual growth are we going to see in the U.S.? There's been some speculation that with all these deep water reserves coming on, we would actually see significant or a meaningful uptick in U.S. oil production, which hasn't really happened since Alaska came on stream. And we peaked in 1972, so it's been a long time. That, and then on the OPEC side, looking at how much do they actually comply with their cuts that they put in place, and then how quickly do they bring back production. One of the ironic things is, as they start to hike their quotas, in other words, bringing more oil back onto the market, that can actually be bullish for oil because it's shrinking that spare capacity. So while that means more supply, it also means that there's less of a cushion against future demand or supply shocks.
We started by talking about the winter storms and the effects on the U.S. job sector. What about the storm's effect on the natural gas market? Prices have been below the $5 level for a little while now, primarily because we seem to have the worst of winter behind us. We're about 2 weeks away from the official end. But the big build we saw last year remains higher than usual in terms of stockpiles for gas.
Yeah, I mean, gas stockpiles, I think that, if you went into the beginning of this heating season and said that stockpile is going to be pretty much on the 5-year average right now, or this close to the 5-year average, people would have thought you were crazy. But we have had the coldest winter since the 70s, and really not just here, but also all over the world. China has been, except for Canada, I guess, where they're having the Olympics, but China and Europe have had very, very cold winters, driven a lot of demand there. So we're pretty much right on the average. Now, the big question I think that the market's looking at is, we are maybe 3 or 4 weeks away from the end of the real heating season. As we move into the spring, into the shoulder season, and we start to see builds in those inventories or those stockpiles, how quickly is that going to happen? There's a lot of concern out there that the production really hasn't dropped off that much because the horizontal rig count is actually at a brand new all-time high, while the vertical rig count is down sharply from its 2008 highs. And what that suggests is that rigs are coming back online to drill in places like the Haynesville Shale, basically the shale, the big unconventional and shale plays around the U.S. Is really strong production growth from those plays going to offset any decline we see from conventional plays? And if so, will we see those inventories pop right back up to very, very bloated, glutted levels by summertime, before the demand comes in for cooling?
Yeah, you came right to the doorstep of my final question, Elliott, which is how long until we're at the same position this year where we were last year? That is questioning how much storage space we have left for these gas stockpiles.
Well, I mean, there are a couple of factors in there. First of all, it's how much do you believe the data that we have on production from the EIA? The EIA 914 data is very controversial. There has been several producers have come out and said they think that the EIA is overestimating U.S. production. So there is a chance that might not be quite as rosy as is being painted right now. We have seen some larger drawdowns than the weather would suggest. How quickly does industrial demand for gas come back? Remember, that's the largest chunk of the market, really.
Which seems to be building right now.
It seems to be building with the economy, and that's a very, very economy-sensitive part of the natural gas market. So does demand come back? What's supply look like? And then how hot is the summer? Last year we had a very, very cool summer, and that really contributed to the spike in natural gas inventories. But if that all turns out, right now I think the market's expectations are very low. I think the consensus is we're going to see pretty strong production, not a humongous return in demand. We'll see somewhat of a bounce back, but nothing like we saw, say, back when the economy was doing reasonably well.
Right.
And that we're going to see a glut of natural gas by the end of summer again, and we're going to be talking about the same thing we were talking about last fall, this coming fall. I think that that's kind of already priced in to a degree. It'll be interesting to see if that doesn't happen. I don't think it's going to, even if it doesn't quite happen as badly as the market's expecting, you could actually see gas prices recover a little bit. I tend to think longer term, we need to see $6 or $7 gas for these companies to be out there producing enough gas to meet U.S. demand.
All right, and now we have you on record. Elliott Gue is our regular energy commodities markets analyst with the Energy Letter and the Energy Strategist. Elliott, always good to have you with us.
Good to be here. Thank you.
All right, and thank you for joining us. I'm Tyler Suiters. You're watching Clean Skies News.